Imagine a lake. On one side, a pump pours water in. On the other, a drain quietly pulls water out. When I was younger, I thought puzzles like this were silly. Why would anyone design a lake that fills and empties at the same time? It felt like a trick question with no connection to real life. But years later, I realized that this puzzle isn't silly at all. It's a mirror of how modern money works. Central banks play the same game, pouring liquidity in with one hand while draining it out with the other. They cut interest rates to make money feel cheap, but at the same time, they shrink their balance sheets to pull cash back out of the system. Think of the Federal Reserve. It lowers interest rates, which encourages borrowing, mortgages, credit lines, and stock buying. That's the pump. But simultaneously, it sells off bonds it used to hold or lets them mature without reinvesting. That's the drain. Most people see only the pump. They cheer when rates drop, assuming the economy is being rescued. But behind the curtain, the drain may be working faster than the pump, meaning the net flow of money is actually shrinking. Just like the lake puzzle, what looks like a fill-up is really a slow drain toward empty. This isn't theory, it's happening now in the US, Europe, and Japan. All three have flirted with rate cuts or paused hikes, which makes headlines about stimulus and support. But behind the scenes, all three are reducing their balance sheets. They're selling bonds, letting assets roll off, and pulling money back into the vault. Why does this matter? Because money is not free. When rates were pushed above 5% recently, dollars became expensive. Fewer people borrowed, fewer businesses expanded, and the circulation of cash slowed down. That's the drain at work. And here's the twist. When banks themselves hold bonds that have fallen in value, they get stuck. Imagine buying a government bond for $100 only to see it trade at 9. If you sell, you lock in a loss. If you don't sell, your cash is frozen. Either way, your balance sheet is weak. The only lifeline is if the Fed buys the bond from you at $100, even if it's worth less. That's how banks magically turn dead money into living money. But right now, the Fed isn't playing savior. It's not buying more bonds. In fact, it's selling them. That leaves banks holding the bag, and it leaves less cash sloshing around the system. Think of it this way. If you deposit $1,000 at a bank, that bank might use it to buy government bonds. Normally, they'd feel safe doing that. But if the value of those bonds plunges, your bank suddenly looks fragile. And if you and everyone else demand your deposits back, there may not be enough liquid cash on hand. This is why balance sheets matter more than press conferences. The talking point is stimulus. The reality is drain. Let's pause for a moment and widen the lens. Money has cycles of being cheap and being expensive. When rates are low, dollars flow freely. When rates are high, dollars tighten like a noose. Central banks pretend to walk a straight line, but really they are juggling contradictions, easing with one hand, tightening with the other. Here's the lesson for us. Don't get hypnotized by the surface story. The lake might look like it's filling, but you have to check if there's a drain at the bottom. When the United States shifts policy, the whole world feels the tremor. Dollars are the lifeblood of global trade. Countries need them to buy oil, pay debts, and import food. If the Federal Reserve drains liquidity, it's not just an American problem. It becomes a global shortage. Look at history. In 1997, the Thai baht collapsed when dollar reserves ran dry. That single spark spread into a regional crisis, toppling currencies across Asia. The same pattern is possible today. When the dollar is scarce, weaker economies scramble, bidding higher and higher just to secure enough currency to keep the lights on. Meanwhile, Europe and Japan aren't offering relief. They too are shrinking their balance sheets. That means three of the largest financial powers are pulling money out at the same time. Imagine a giant concert where three main speakers all go silent. The room doesn't just get quieter, it goes dead. So what happens when dollars, euros, and yen all grow scarce? The strongest players, the US, Europe, Japan, can still print when they must. But emerging economies don't have that luxury. They borrow in dollars but earn in local currency. When the global pump shuts off, they're the ones left gasping. This shortage strategy has a pattern. Step 1, create scarcity. Pull cash from the system. Step 2, let the weaker economies crack under the pressure. Their currencies sink, their banks wobble, and their citizens rush to convert local money into dollars they can't get. Step 3, swoop in. Wall Street and global giants arrive with the scarce dollars ready to buy distressed assets at pennies on the dollar. It's a ruthless playbook, but it works. It worked in Asia in the 90s. It worked in Latin America before that, and it may be working now. If this sounds like conspiracy, pause. It doesn't require secrecy. These moves are public. Balance sheet numbers are published. bond auctions are announced. It's not hidden, it's just ignored by most people. That's why gold matters in this story. When central banks and billionaires see the writing on the wall, they buy the one thing that isn't tied to someone else's promise. Gold doesn't pay interest. It doesn't have quarterly earnings, but it also doesn't default. In the past year, central banks worldwide bought more gold than U.S. treasuries. That hasn't happened in decades. Why would they do that if the dollar system was healthy? Because they don't want promises anymore. They want something tangible. And it's not just countries. Ultra-wealthy families in Asia and the Middle East are buying physical gold, not paper ETFs. They store bars in private vaults outside the reach of shaky banking systems. Some even lend it out to jewelers or pledge it as collateral for loans, turning static wealth into usable capital. Think about that shift. For years, the safest asset in the world was a U.S. Treasury bond. Today, the quiet vote of central banks and billionaires says otherwise. They're shifting from promises on paper to metal in vaults. This should be a signal to the rest of us. You don't have to copy every move of a billionaire, but you can learn from what they fear. If they worry about paper promises, maybe we should too. The real story is not just interest rates or unemployment numbers. It's the silent draining of global liquidity and the parallel rush toward assets that can't be printed. Shall I move straight into part 3, where we explore the psychology of investors, the rise of gold and silver, and how individuals can adapt without getting crushed? Markets are not just math. They are human emotions stacked on top of balance sheets. Fear and greed drive more decisions than formulas ever could. That's why shifts in gold and silver tell us as much about psychology as they do about economics. Gold is safety, silver is opportunity. When people sense danger, they run to gold. When they sense momentum, they chase silver. Recently, silver has broken resistance levels, signaling that large investors are betting on a trend, not just protection. It's not a coincidence that gold and silver often rise together, but silver tends to move faster when the herd joins. Imagine two neighbors. One buys gold bars and hides them in a safe. He's worried about collapse. The other buys silver futures, excited about the rally. He's betting not only on fear, but also on profit. Both are reacting to the same storm, but in different ways. This split mindset exists everywhere. Some investors ask, is now the right time to buy at these high levels? That's the question of someone arriving late, worried about missing out. Others ask, should I take profits now? That's the question of someone who prepared earlier, entered when the signals were forming, and can afford patience. The difference is not knowledge, but timing. When you build a position before the headlines, you own both the asset and the peace of mind. When you chase after the crowd, every small drop feels like disaster. That's why new investors often panic and sell at the worst possible moment. Cycles of fear and greed repeat. One group buys early and waits through noise. The other group waits for reassurance, buys late, and panics early. The market rewards patience and punishes hesitation. Look back to the housing bubble. Many thought rising prices meant safety, not risk. By the time they realized the drain was stronger than the pump, values collapsed. Today, the same mindset hides in plain sight. People believe rate cuts mean recovery, without asking what the balance sheet is doing in the shadows. The truth is, rate cuts alone rarely solve unemployment or inflation. Businesses don't hire more people just because their loan payments shrink slightly. Families don't suddenly spend more because their credit card interest is a little lower. Real growth comes from stability, not just cheap money. And stability is exactly what's missing. Inflation is driven less by reckless consumer spending and more by global shocks, wars, tariffs, disrupted supply chains. You can't cure that by nudging interest rates down. You can only mask it for a while. So the lesson for the individual is simple. Don't mistake the pump for safety. Don't let headlines about lower rates convince you the crisis is over. Watch the drain, watch what's being sold off, what's being withdrawn, and where the big money is quietly moving. The wealthy are not hoarding cash. They're moving into assets that cannot be printed away. Some of that is gold, some is real estate in stable regions, some is businesses tied to necessities like food, water, or energy. The pattern repeats because human psychology repeats. Most people ignore the signs until the headlines scream at them. A few prepare early, endure the noise, and then emerge stronger when the cycle resets. Shall I continue into part 4, where the script moves toward global consequences, lessons for everyday investors, and how to position for resilience? When liquidity dries up in the strongest currencies, the weakest economies crack first. Nations that depend on exporting goods for dollars or euros suddenly face a drought. They still need to import food, medicine, and energy, but the hard currency to pay for it vanishes. This is not an abstract scenario. In past decades, entire countries saw their currencies collapse in weeks. The pattern was predictable. A local economy relied on dollar inflows. Those inflows slowed. People rushed to trade local money for dollars, and when none were available, the local currency imploded. Assets once considered stable were sold for scraps. This is the danger of global dependence on just a few currencies. More than half of the world's reserves are in dollars, a quarter are in euros, a smaller slice is in yen. Together they make up nearly 90% of global reserves. When all three tighten at once, the oxygen level of the financial world drops.
In this environment, wealth does not vanish. It changes hands. Scarcity creates opportunity for those holding the scarce resource. That's why financial giants wait patiently. When the crisis hits, they arrive with the cash everyone else lacks. They buy ports, energy companies, farmland, and banks for a fraction of their worth. After the dust clears, they control the backbone of those economies. The question then becomes, how does the individual protect themselves when entire nations are vulnerable? The answer begins with awareness. Recognize that central banks may say one thing and do another. Rate cuts may be headlines, but balance sheet moves are the true signal. The second step is positioning. This doesn't mean panic buying every shiny metal or exotic asset. It means holding some wealth outside of paper promises. Gold, silver, or even productive land can serve as anchors when currencies swing wildly.
The third step is discipline. Crises are emotional storms. When everyone else is panicking, the temptation is to join the stampede. The stronger play is to plan in calm times and execute in storms. History rewards those who prepare in silence, not those who react in chaos. All of this sounds heavy, but it also carries hope, because with every cycle of scarcity comes opportunity. Entire fortunes have been built, not by chasing trends, but by understanding when the drain is stronger than the pump and preparing accordingly. The world is moving toward another inflection point. Central banks are pulling money out. Gold demand is surging. Inflation refuses to behave like textbooks say it should. This is the kind of storm that destroys the unprepared but elevates those who recognize it early. Do you want me to continue into part 5, where I'll close the loop with practical investor lessons, historical parallels, and a forward-looking conclusion? History whispers the same lessons over and over. In the 70s, inflation surged because of oil shocks and geopolitical tension. The response was high interest rates that choked the economy before stability returned. In the 90s, Asia collapsed when dollars became scarce. Each time, those who only trusted official reassurances were blindsided. Those who studied the flow of money, who watched the drain, not just the pump, came out stronger. Today, the signals echo those old patterns. Governments say rate cuts will ease pain, yet balance sheets are shrinking. Debt loads are climbing, yet bond values are slipping. At the same time, gold is moving as if the system has already decided. This is why patience matters more than prediction. You don't need to know the exact month of a crisis. You only need to know that cycles exist and that preparation beats reaction. For everyday investors, preparation means clarity. Hold assets you understand. Keep some exposure to things that cannot be printed or defaulted on. Avoid leaning too heavily on debt when money is expensive. And most importantly, pay attention to signals that most people dismiss as boring details, like central bank balance sheets. Think of it as sailing. Headlines are the waves, splashing loud and dramatic. Balance sheets are the tide. Waves grab your attention, but tides decide where the ocean really goes. Gold and silver may not be the answer for everyone, but the principle behind them applies broadly. Seek stores of value outside of pure promises. Balance liquidity with resilience. Own things that hold value even if currencies swing. The quiet truth is this: every crisis is also an opportunity. When assets collapse, they don't vanish. They move from weak hands to strong hands. If you can stay calm when others panic, you shift from being prey to being a buyer. Cycles will continue. Central banks will keep playing their double game. Crowds will keep chasing the pump while ignoring the drain. But those who learn to see both sides of the puzzle, the inflow and the outflow, will always have an edge. This is not about predicting doom. It is about understanding the rules of the game and refusing to be a pawn. The world will keep spinning, economies will rise and fall, but the principles of preparation remain timeless. The real test is not whether you can guess the next headline. The real test is whether you can build a strategy strong enough to withstand the storm and flexible enough to seize the calm that follows. The pump fills, the drain empties, the lake looks the same until one day it doesn't. And when that moment comes, those who prepared quietly will already be standing on higher ground. If you found value in this journey, let this be a reminder that knowledge is power only when shared and acted upon. Like this video so it stays in your library, subscribe to join a community that thinks differently about money, and drop a comment with your own perspective. Share it with someone you care about, because sometimes a single idea passed along can change another person's path. I wish you clarity, courage, and a bit of luck on your financial journey. When this video ends, feel free to explore the other stories on this channel. Each one is another step toward resilience and freedom. Thank you for spending your time here today. I'll see you in the next video.